welcome to Signal or Noise. And welcome to an episode we have loosely titled, Hope is on the Horizon. The title of this episode stems from a Moody's economics note, which argues that investors should be starting to breathe a little easier after 2 very challenging years. But is that hope misplaced? And if it is, what do you need to do about it? Joining me are 2 of this country's leading economists who are breaking down the headlines and turning them into those digestible and investable ideas. Our resident economist, Deanna Messina of AMP, is one of them. Hello, Deanna. And joining us this month, this is good, actually one of Deanna's old colleagues, Gareth Ed, who's now the head of Australian economics at CBA. Hello to you both. Thanks for joining me.
G'day. It's nice to be here.
Let's start with what domestic investors have really been putting a lot of hope into, and that's the RBA beginning its rate cutting cycle during what's left of 2024. As I'm sure most of you know, or have at least read in the press, most central banks around the world have started to cut interest rates, but our own central bank has lagged behind. For now, rates markets seem to be taking the RBA's forward guidance at their word, as evidenced here by a recent snapshot of the futures markets. And in the meantime, shares are not the only thing off to the races. The Australian dollar recently surged to 12-month highs, thanks in part to the RBA, but also in large part to the Chinese government's stimulus announcements. So, panel, and Dee, I'm going to start with you. Are there any signals in the economic data which suggest the RBA may cut rates this year? And if so, which ones?
Probably the only signal that would suggest a near-term rate cut would be inflation coming down faster than expected. And we get the September CPI data soon, and that should show headline inflation at about, on our forecast, 2.7% year on year, which is obviously below the 3% upper band of the Reserve Bank's inflation target. It's obviously skewed by what's going on with energy subsidies and the like. On the trim mean number, we think that that number will be closer to about 3.2%. So obviously much lower compared to where it was even a year ago. And actually not too far from some of our global peers. The US version of the trim mean, their core CPI is actually at 3.2% right now. The other piece of data that would have suggested a rate cut would have been the unemployment rate, but it just hasn't moved higher as we would have thought by now. So I don't think it's going to move up in time for a rate cut before the end of this year. Yeah,
we'll talk about the labour market a little more in a bit. But Gareth, to you, do you find any signals in the economic data which suggest the RBA may cut rates this year?
Yeah, look, I agree with what Deanna said about a potential upcoming signal in terms of the Q3 CPI, but obviously we haven't seen that yet. We have had, though, a number of monthly prices gauges. Now, these are all sort of second tier, but if you look at the NAB Business Survey, the PMIs, the Melbourne Institute, Trim Mean Measure, they're all looking pretty good for the September quarter. Now, if it turns out to be the case that Q3 CPI comes in a little bit below where the RBA is expecting it, which is our forecast, then those partial bits of data will indeed turn out to be signal. But if we do get a number which is more in line with the RBA's thinking or potentially firmer, then I think a lot of those monthly gauges will end up being noise. So I guess to reiterate what Deanna said, that it's very much about an inflation print, I think, if there's any chance the RBA is going to cut rates this year.
You have a relatively added consensus call, which I want to build on, suggesting the RBA can still cut rates this year. I think December is your call, is it not?
Yeah, look, we've held that. Obviously, with the labour market data that came out for September that showed a big lift in jobs and the unemployment rate holding it firm at 4.1%, reduced our conviction on that. But given we get the important CPI next week, we thought we'll just wait and see how we go on those numbers before potentially changing the call. The other thing I'd say too that's going to feed into the whether or not we get a rate cut by year end is Q3 GDP. So that will come out in the first week of December, so just before the December board meeting. The RBA has been expecting a decent pickup in household consumption because of the stage 3 tax cuts. If that's not in the data and it turns out to be the case that we get another weak quarter of consumer spending, then you'd have to say that and the potential for a downside surprise on CPI could be the sort of data that sees them cut.
Well, while you talk of that, I know you brought along a couple of charts just to kind of go through this. One is inflation, so we'll put that up now. Your forecast is for what for Q3 for soon?
So 0.7% on the trim mean. So the chart there shows you the quarterly change in trim mean against our forecast for Q3, and then also the 6-month annualised rate, which I think is quite important because there's been a bit of a narrative going around that the disinflation process in Australia is stalled and that inflation's proving quite sticky. But part of that's because we've had this big number from Q3 of last year sitting in the annual calculation. And if we're right and we get a number around about 0.7% for Q3 on trim mean, that's going to take 6-month annualised core inflation to 3%. And I think at that point, if we get that sort of number, it will actually start to see the debate shift a bit, because it will be clear that we've actually made quite a bit more progress than I think is being widely credited at the moment in terms of bringing inflation back to target.
Yep, all right, well, thank you for that. Deanna, I know you were in the 2024 camp. You pushed that out a little bit to early 25. Can you talk us through your conviction for your call, and I guess what the biggest risk is to that call as well?
Well, we're so obsessed with what month the Reserve Bank is going to go in, and of course it does matter for investors and if you're making trading decisions on that 1 month. But I think more importantly, it doesn't really matter in the big scheme of things if it's December, if it's February. In the next 6 months, I think it's very likely that we're going to get a rate cut. And our forecast right now is that it will be by February, because basically we see inflation coming down quicker than the Reserve Bank's been forecasting. The unemployment rate will probably be a bit lower than where we were expecting it to be. But I don't think that will be an impediment to the Reserve Bank cutting rates. We've sort of seen that narrative play out overseas, that as the pace of inflation went down, a lot of the global central banks were very comfortable to cut rates. And the US hasn't had a huge increase to the unemployment rate, but they still decided to cut rates by 50 basis points in the first meeting. So we think that by February, sort of the stars will all align for the Reserve Bank to start cutting rates. Again, if it's December, if it's February, if it's March, I don't really know that it matters too much. The more important story to me is that we're going to get a rate cut in the next 6 months.
All right, well, let's pick up on that and talk to that labour market thing, which I know you mentioned earlier. There's an interesting quote out in the economics community that's ruffled a few feathers. It's from Paul Bloxham of HSBC. And he offered this following the most recent labour force report. Their central case is that the RBA does not begin to cut until the second quarter of 2025. But, and this is the caveat, he also sees a growing risk that the RBA may miss the easing phase altogether, and the numbers from the recent jobs print actually add to that risk. So, Gareth and Deanna, feel free for one of you or both of you to jump in here. Does Paul have a point? And if hypothetically the RBA was not to cut rates at all, what effect does that have on different parts of the economy?
I find it very difficult to see that situation, because if every other major central bank is cutting rates, why is Australia any different at a time when we have had a faster tightening to households than all the other major economies that we look at? Canada, New Zealand, the US, UK, the European countries as well. Yes, we didn't tighten rates as much, but our mortgage rates went up by more than all of those countries combined. And we've seen a very fast slowing in household consumption, more than all those economies, and a commensurate decline in real household disposable income growth, which was actually one of the worst performers in Australia relative to some of our peers in the last 12 months. I guess Paul's point is that just inflation's going to prove too high for the Reserve Bank to cut rates, but as Gareth pointed out, all those leading indicators of inflation suggest that we don't have an inflation problem.
Yeah, no, absolutely. Gareth, do you want to jump in on that?
Oh, look, I guess I'd make 2 points. If the Reserve Bank was going to miss out on easing altogether, it would imply that policy is currently not restrictive and that we're at some kind of neutral level at the moment. And we would disagree there. I mean, I think if we're right and we see inflation continue to come down, then that would be an indication that policy is restrictive. You also look at what's happened in terms of GDP growth over the past 18 months, particularly with respect to the consumer. It's been very weak and it's been going backwards on a per capita basis. So those signals, and the fact the unemployment rate, even though people are sort of recently saying it's not going up, if you look at it over an 18-month period, it's gone from 3.5% to 4.1%. So I think there's plenty of evidence that policy is restrictive, which means rates should come down at some point. The one thing, though, that as a risk you could say that would get in the way of the RBA cutting rates would be changes to fiscal policy. We've got the election, which will come up next year, likely by May. And if it turns out to be the case, the RBA hasn't been able to cut rates and the government feels compelled to push in some stimulus ahead of the election, that could be the kind of thing that could see rates not come down. But you've really got to frame that as a risk and an unknown, not so much as a base case.
Yeah, no, absolutely. Before we move on from this topic and move to something else, Deanna, I thought it would be just good, we can round out this conversation by talking about your chart, which is the unemployment rate change. since 2019, which seems like an eternity ago, thanks to COVID.
It was a different time, that's right.
Yeah.
I wanted to bring this chart along because I guess it sort of highlights why the Reserve Bank thinks that Australia is a little bit different, in the sense of why haven't we started cutting rates like some of our peers. And while in the short term we have had the same increase to the unemployment rate as a country like the US, if you look at it compared to pre-COVID levels, our unemployment rate is still about 1% below where it was before the pandemic started. And I know that before the pandemic we did have a pretty loose labour market. We were trying to reduce the unemployment rate, but it again goes to the point that the labour market is on some measures still on the tighter end of the spectrum compared to what the Reserve Bank would like, and compared to some of our peers, which is perhaps why we haven't seen those rate cuts eventuate alongside the higher relative inflation that we've had in the past year.
Right, so that's the hope for the RBA and whether it was going to cut. Let's talk about a different kind of hope now for our second topic, Chinese stimulus. Recently, China's central bank unveiled its biggest stimulus since the COVID pandemic to pull the economy out of its deflationary funk and back towards the government's growth target. But analysts and markets alike think, and hope, that more fiscal help is vital to hit these goals. But even economists and analysts are split on this. You've got Moody's on the one hand saying that Beijing's stimulus measures are not a game changer because you cannot ignore the impact of that weak labour market, while you've got Invesco on the other side saying that this latest round of stimulus is the real deal. And there has also been fresh reporting suggesting that the Chinese government may sell another $850 billion in special bonds to help fund future stimulus packages. From September 24th to October 8th, so that kind of 2-week window when we first heard of this massive stimulus bazooka, Chinese stocks, as in the CSI 300, rallied 27%. But when we didn't get more, a lot of those gains were then erased. Gareth, I'll turn to you now. Are there any signals for Australian investors from the existing stimulus announcements, or are the announcements noise for investors until we see the cash dished out?
I think it's noise because we're waiting to actually see what the official policy announcement will be in terms of fiscal stimulus. Now that will come at the National People's Congress either later on this month, early next month, and it could even come after the US election if the Chinese authorities want to wait and see the outcome of the election before announcing what their policy stimulus is going to look like specifically. But at the moment, everyone's just sitting there waiting to see exactly what it is. So I'd just say we're in a place of noise at the moment.
Yeah, no, absolutely. Deanna, what about you? Do you see any signals, or is it all noise until it gets deployed?
I think it's a signal. The share market has not moved this much on any of the other piecemeal policies that we've seen from China in the last 12 months. This has definitely been the biggest rally that we've had. And I think it's because it seems like it's coordinated. It's come from the PBOC and it's come from the fiscal side. So we've had measures on housing, we've had measures on lending, we've had measures on local government bond issuance, around trying to improve liquidity in the market, and also around trying to get the share market buoyant again. So when you've sort of seen it across all these different sectors of the economy, I think it's a signal that China is willing to step up and get growth to increase before the end of the year. We know that for the December quarter, if they want to meet their 5% target, then GDP growth in that quarter has to be much stronger compared to the last 3 quarters, given that we've had a pretty soft-ish year of growth in China. It's not necessarily to say that you should go out and be buying Chinese shares. I think you have to have a certain risk appetite and also be cognizant that we could see some changes after the US election. I agree with Gareth that I think that they'll wait and see the outcome of the election before we get any further ideas about the actual size of the policy. I've seen some brokers try to estimate that this is worth 5% of GDP or 6% of GDP. We don't have enough clarity yet as to what the actual size of the policy will be, but it does look like it's shaping up to be the second largest policy that we've had from China since about 2008, when they unleashed their largest policy stimulus package ever. So that's why I think it's a signal.
So Deanna, picking up on what you were just saying then, obviously you were just saying you don't have to rush out and buy Chinese shares, but let's give them the benefit of the doubt. Let's say more is coming. Is there anything that Australian investors can be doing to prepare for whatever might come next?
Well, the response so far from the stimulus announcements that we've had to date, I think has helped global shares more broadly to keep rallying in an environment where we've still got geopolitical risks, we've got the US election coming up in 2 weeks, But there's more to it than that as well. I mean, we've still had pretty good economic data that's come out. So I don't think that the Chinese stimulus package on its own is the only positive driver of markets. It's obviously helped the Chinese share market, but I do think that you have to have a certain risk appetite to want to invest in China in the short term. You need to be following the market very closely. You need to be watching the stimulus announcements very closely. And in the past 18 months, some investors have been burned by expectations that the stimulus measures are going to gain some traction, and they haven't, because the broader structural issues in China around an aging population, the fact that households are in a liquidity trap and very poor growth in the housing market and oversupply in housing hasn't gone away. And I don't think that the stimulus measures that have been announced to date will help those measures in the short term. Maybe in the long term. That's why I would sort of be wary if you're buying into Chinese shares, just to sort of be mindful that it could just be a short-term trading opportunity. Some of these longer-term risks in China still exist, but certainly from a short-term point of view, Chinese shares look much more attractive from a valuation perspective.
All right, so let's move on to our third topic. We talked about investors hoping for the RBA to cut rates, investors hoping for more stimulus from China. Let's talk about the biggest and probably most overarching hope of them all, a soft landing. While investors in the RBA continue to hope for that soft landing, the Australian economy also remains in a per capita recession. The ABS's data suggests that there has been 6 consecutive quarters of GDP per capita falls. Globally speaking, JP Morgan says there is a 35% chance of a recession by the end of 2024, while Goldman Sachs' CFO says the Fed's recent 50 basis point cut was actually the sign of a soft landing. Their economics team thinks there is just a 15% chance of a US recession, despite all the risks that you and I know very well: the Middle East, Ukraine, the US election, among all the others. So, Gareth, I'm going to pick this up with you. Do you think markets' hopes for a soft landing are misplaced, or are there enough signals for the market to be rewarded?
No, I don't think they're misplaced. I think there are enough signals that the soft landing is on track here in Australia. And we probably wouldn't look to a technical definition of a recession being met or not to say, did we have a hard or soft landing? Because population growth is such a strong tailwind in Australia that it's very hard for us, outside of a negative shock, to go backwards in consecutive quarters. I'd be looking to the labour market to say, is the landing soft or not in Australia? And you'd have to say the gradual increase that we've had in the unemployment rate has been pretty modest. And that's indicative of a soft landing, provided inflation continues to come back to the target. And we think that's going to be apparent in the data in Q3. I would just add, though, that even though we talk about hard or soft landings from an aggregate perspective, there's still quite a lot of households out there in Australia that are doing it quite tough at the moment. The RBA in their financial stability review said that 1 in 20 borrowers out there are currently in negative cash flow. So that would suggest that there are pressure points. There are people out there who would probably say, well, hang on, my own circumstances are pretty hard at the moment, and that feels like a hard landing. But when we're looking at the economy in aggregate, we think we're on course still for that soft landing here.
Okay, Deanna, what do you say to this?
Well, our own forecasts are that GDP growth is actually going to improve from here, be soft, but we're running at just above 1% year-on-year GDP growth, so a slight improvement means that the soft landing theory has passed, and our own forecast for growth next year is for that continued pickup, still below Australia's potential of 2.5% to 2.75%, maybe a little bit higher now with high population growth. But we don't think that we're going to have a recession here. But as Gareth said, it is quite mixed across different sectors.
Yeah, absolutely. And that, my friends, is Signal or Noise. A big thank you to my panellists, to Gareth, head of the Commonwealth Bank. Thank you for coming on, so really appreciate it. And Deanna Messina of AP, always, thank you very much. Join us next time for The Property Show. Until then, make sure you are subscribed to the Livewire website, as well as our YouTube channel and our podcast, and we'll see you then. Thanks for watching and listening.